Hello, I'm Dominic Hobson, co-founder of Future of Finance. My guest today is Nigel Verdon, CEO and founder of Railsbank, the open finance platform on a mission to bypass legacy banking systems by, in its own words, enabling any company to be a fintech. Central to that mission is a multi-purpose API developers can build into their apps to enable any sort of business to offer banking services to their customers. Nigel, thank you for joining us.
Thank you for the invitation.
Now, Nigel, to be honest, I've always found it quite hard to work out exactly what it is that Railsbank does. When I go to Crunchbase, I see you listed under all sorts of different things: banking, developer APIs, finance, financial services, fintech, payments, software, all sorts of things. Is the clue in the name? The industry, particularly the payments industry, uses the term Rails to refer to payments market infrastructure, really. Are Rails what you provide, or do you ever worry that that's a misleading description of what you do? How can we pin down what it is that Railsbank does?
Sure. Rails is fundamental to what we do. The railroads actually opened up the west coast of the US to the gold rush. And so Rails are generally viewed not just in the payments industry, but in pretty much any industry, from capital markets all the way through to wealth, to even non-finance industries, as the infrastructure that allows people to build their businesses or their wealth on top of, if you looked at it from the gold rush side. So we see ourselves as essentially the financial services infrastructure or layer of the internet that people can use, like they use AWS to build their core infrastructure of behind their app, behind their business. We see us as being a financial services layer, so you don't have to worry about settlement clearing, being a direct clearer with the Bank of England, for example, being members of schemes like Visa, MasterCard, all the settlement side, the risk management side, all those pieces, that operational stuff. We just provide very simple APIs that abstract all the complexity and all the market terminology too, because your grandmother doesn't go and buy Swift payments. Your grandmother goes down to the bank to send money from Ireland over to Munich. She doesn't realize it's for Swift, so we abstract all that industry stuff away as well. So we are an API that is sitting on top of an operations and a regulatory business that enables any customer of ours to create what we call financial experiences for their consumers, where that financial experience can be a wage advancing, buy now, pay later, a banking experience, a reward scheme experience that is directly embedded into their own app or their customer journeys. And that is what we do. So if you looked at it as an abstract, it's the same as Amazon Web Services do for just core infrastructure for building your technology business on top of.
To pick up that metaphor you first used about the California gold rush, would it be fair to say you're in the business of selling shovels rather than panning for gold?
Oh, absolutely. We're a supplier that you can get your shovels here, you can get your wheelbarrows, you can get your sieves, and we then enable people to go and find their gold.
Right. Well, something more interesting is happening in California these days, and among the well-known Californian companies is, of course, Apple. And you often compare yourselves to Apple Mac and iTunes. Can you explain that metaphor to us?
Sure. So the music industry, and I was very close to the music industry growing up, and still am. Lots of colleagues still operate in that world. When the Apple launched essentially the iTunes, and they digitized the music track, and it had been done before with the MP4, but nobody really used it. They created an industry that was centered around, instead of buying an album with 30 songs you just didn't want, so you paid for 30 songs for one song you did want, and they took it out, you could buy a single unit for 99 cents. And so what that radically changed was a thinking within the music industry that there's different ways and models that you can operate and go to direct to consumer. So people like Spotify never existed, SoundCloud, YouTube as well from the music side. And by sort of deconstructing everything to a pure digital component, it allowed new businesses to be built up around that digital component, called essentially an iTunes or a track. And so we see the same thing. We've deconstructed banking down to issue account, send money, receive money, collect money, cards down to issue card, spend money on a card, control a card, which is like reset PIN. As a credit, the same thing as issue a revolver loan, attach it to card, and you've then got a credit card. And so that bringing it down to little components or pieces of Lego, you can then go and build custom experiences for within your own user experience. So as we come back to wage advancing, buy now, pay later from the credit side, you've got neo banking experiences. You've got financial experiences on checkout as well, if you need to borrow there or you need to delay payments and stuff. So it's the componentization with the digital components, both analog components, is what we've done on the tech layer. We've also removed the legacy from ourselves from the central banks to the consumer, because a lot of the industry who have APIs and everything, lots of banks have APIs, they still sit on a ton of legacy technology, legacy risk management, legacy compliance thinking, and et cetera, et cetera. So if you sit on, say, atop of a high street bank with your lovely API business, the high street bank tells you what customers you can and can't bring on board. We go direct from the central bank to consumer. And by doing that, or from a payment scheme like UK Faster Payments, Visa, MasterCard, directly to the consumer. And so we're controlling the full end-to-end vertical stack, the economics, the risk management, the compliance policies, et cetera, so we can deliver to our customers at the speed and at the pace and at the right the risk controls in it that are hindering. The sort of legacy is hindering within the industry. And coming back to music, that's what happened. It's freed up the music industry from the record labels being the gatekeepers of the industry, to the music, to the artist, to the marketing, to the custodian of the catalogs. And the same with the banks, that very much they have been the gatekeepers to the central banks, to capital, to credit, to capital markets, to payment schemes, etc. We've removed that. So we've opened up the industry, and that's our end vision too, to do that on a global basis. And we're live in US, UK, Europe, and parts of Southeast Asia and Australia now as well.
Mm-hmm. We'll come on to that. If I've understood you correctly, you've effectively reduced banking to a set of generic components which developers then put together in any way they like to achieve the effects they wish to achieve. Now, is that what enables you to fulfill the claim which anyone going to your website will read on the first page, that you and your co-founder want to give everyone access to global banking with 5 lines of code? Is it that reduction of banking to these set of generic but core functions like issue or pay that enables you to make that claim about the 5 lines of code?
Exactly. We've also tried to use global words rather than words like ACH you use in the US, because nobody knows what an ACH is. So yes, we have, by deconstructing everything and giving it global naming, and then hiding all the complexity of localization and all the industry infrastructure. That's enabled us to do that. But tipping our head off to a wonderful company called Stripe, they actually did it with 2 lines of code when they originally marketed the business and they launched it. And I was going to push for 3. My co-founder said, reality, Nigel, if you actually write the code and do it, like in the early days, it was around 5 lines of code. You could issue an account or issue a ledger, onboard a customer, issue a ledger, and send money and receive money to it, literally with 5 lines of code.
And that's what enables your marketing materials to emphasize these 2 sets of services. You give people access to these wholesale financial services, banking services you like. They can open accounts, they can send money, they can receive money, they can do FX as well, I understand. They can collect money by direct debits, subscriptions. They can issue credit. They can issue debit cards. They can borrow money themselves. And you can do all that through an API. And on your website, so it takes you 30 seconds to register for that API and 15 minutes to go live. It sounds too good to be true. Is that really possible?
Yeah, so our sandboxes on the website. So we have two sandboxes. One a dummy money sandbox called Plaid, which you can be signed up in 15 seconds or so and start playing with our APIs and using our cookbooks, so our guides, to show you how you would do the very basics of a neobank account. And this other sandbox, which is Play Live, which has real money, but it's all below the compliance limits. So it's very restricted. You couldn't do anything that's meaningful on it, but you can show it works with payments of around 50 pence and then aggregate up to £5-10. So the Play Live allows you to actually show it working with real money. And we set our interns when they join the company. You have 2 hours to build the basics of a neobank using our APIs, and most of them do that. So it's a very fast way of going to market. And then to then go to the full live platform, you go through the normal onboarding that you would do in a regulated business.
Now, a lot of companies don't actually want to be in the banking business, but they do want to be in the business of offering, I don't know, loyalty cards, reward schemes. I suppose really is an extension of their sales and marketing efforts. And what you offer works for that group of clients, as sort of marketing, product manager, developer types as well.
Sure. The Railsbank ledgers, when we built our own essentially core banking platform, we designed it so it could hold any fungible asset. Mm-hmm. And one fungible asset is a fiat currency, so euro, sterling, dollars, etc. And other assets like gold, reward points, telco minutes are all possible on the platform. With customer tally money, which has invented a new unit of gold called a tally, which is, I think, the thousandths of an ounce, if I remember rightly. And tallies are held in tally ledgers, and those tally ledgers you can buy and sell in real time. And all the conversion between fiat and tally happens in real time at the point of buying something with your card or receiving money from, say, UK Faster Payments. And we enable the customer, if they want to make a price on that, to actually provide market making prices so the tally goes into dollar, tally into euro, for example. And so it's whatever your own reward point is into the equivalent of money. So what that means is you can use reward points as a scheme in the ledgers, but you can also add liquidity into them, and they become a mechanism that you can actually be useful and reward people to actually open a loop and use it with a normal Visa or MasterCard debit cards.
What do the regulators think of this? By which I mean that if somebody is making a price in gold or is opening a bank account, do they need to go to the financial regulator and get a license to do that?
So it is licensed business. Gold technically isn't, but as soon as you attach a payment to it, it is. Okay. Okay. So it's we have the customer journey of what we call prototype, launch, and scale. And the prototyping is with those sandboxes, and also when you're on the live environment as well. But what a lot of our customers do, they rent our licenses and our policies, and then all our transaction monitoring that goes on top of that to get them into market fast. So they don't need the 9 to 12 months it's currently taking to get an e-money license in the UK or in parts of Europe. So once they've grown up and they've decided if they want to go into the licensed business or not, or let us carry on running on top of us, they can take whichever route suitable for them. So we don't try and drive the customer into a particular outcome in licensing. It's if you have no interest in going to financial services, which say a brand like McLaren Formula One, there's no real interest. In fact, they're engineers and a phenomenal world-class engineering company. Then you can carry on using our license to add infinitum to build your business on top of. And others in the fintech world who want to launch and prototype and raise capital, so they can then grow and own their own destiny from the licensing side, they can do that too. So we have those different journeys we help customers on using our licenses, and also supporting them when they get their own, if that's what they think is right for their business.
And are licensed entities making use of your services as well, like a bank with a banking license coming along and
Yeah,
making use of what you
we
provide?
don't actually sell to banks because it's that's not our market at all. It's so there are regulated businesses, wealth management. You could technically call them bank, but there's wealth management, insurance, the payments companies, lenders, for example. We have quite a number of regulated businesses sitting on top of us.
And you mentioned ACH as a minute ago. How do you work with, I suppose, the real rails, the payments market infrastructures, the automated clearinghouses, the real-time gross settlement systems, the central banks, SWIFT? Are these part of your universe, or? Yeah,
we're directly connected into Bank of England. We're a direct clearer of sterling ourselves. We're a direct clearer of euros. So we connect into RTGS via Vocalink, if I remember rightly. Everybody has to connect via Vocalink because that's what runs the core of RTGS.
Right. Who are Swift's great rivals? You don't have a Swift account then?
Oh, we do. We're a SUPI member of Swift as well. So we're a full bank grade member of Swift. It's PayRGV is our Swift code.
Can I ask you about this term embedded finance? It's a relatively new one. We sometimes call it banking as a service. And I think most people think of banking as a service as the ability to make a payment without actually having to re-enter your bank details, or indeed borrow money from a bank without having to actually go to the bank and ask to borrow it. And I can see how APIs make those processes much, much easier. How did this market come into existence? How big do you think it can eventually be? I would have thought extremely large.
Sure, the size of the market, there's some good work done by Simon Torrance and also one of the partners at Bain Capital, which they've done some clever maths, and between credit, between payments, and between insurance, they think it's about $7 trillion market by 2030, if I remember rightly, the research. And it all seems quite well thought through research, and I have no reason to disbelieve that. And we also believe in that too. In terms of what banking as a service and all these sort of industry terms, and I would say that UK faster payments is an industry term, SWIFT is and everything. People don't go out and say, I want to go buy some banking as a service. They go out and say, I want to be able to provide wage advancing to consumers so that with a fixed price, so they don't get into the issue of compound interest, or death spiral compound interest. So you're doing good for society and you think there's a business in that. You don't go and say, I want to buy banking as a service. And so that's what embedded finance essentially is. It's looking at those financial experiences that you embed into your customer experience or your value proposition you give to customers. And that's where embedded finance is probably the first way of articulating it. And we seem to think of it more now as when we're talking with customers is talking about financial experience, embedded financial experiences. And that's what we think is what people actually buy and use, because that's what they deliver to their customers. They don't deliver banking as a service. They deliver outcomes, and outcomes are receiving a wage advancing. Outcomes are borrowing money to buy goods on checkout, for example. So if that makes sense, it's an experiential thing rather than a technical functional thing. And traditionally, finance has been very functionally led, especially in the banking world. You read your account, you send money, you receive money, all those components. But those components together, you create experiences from them. And we think the future of finance, pardon the pun, is all about financial experiences.
So people don't buy banking services, they don't buy payment services, they want to buy the things which banking services and payment services allow them to do, like make payments and receive payments.
Spot on, yes.
Absolutely. Now, you've made it sound terribly easy to in effect, make possible that world of embedded finance. But actually, how difficult is it in technical terms to design and build APIs and a platform which people can use across multiple websites, multiple smartphones, multiple industries? In fact, you've described very well how you reduce banking to these core generic components which people can then piece together again. But I suspect that's rather harder to do than it sounds. Or am I wrong?
The API, to come back to the original question, APIs are easy. You just design them. And the art there is designing something that reflects the workflow and the functionality and the using human-centric design principles about language and things that people can use. So APIs, I don't think there's any real intellectual property in them, and somebody could copy our APIs, and I'm not too fussed if they did. And I designed the currency cloud APIs, which my last business I founded. So everybody has APIs, and the APIs are just the entry point into the platform. Then it starts becoming a bit more difficult, because having a platform that is up 24/7 and it's delivering multiple millions or billions of transactions, and it has to be reliable and safe and secure and all those pieces. So the technology has to be that. You then got to have your operations, which is the moving of money, the liquidity management, settlement clearing, risk management, the reconciliations and everything. That all also has to happen in 24/7 as well, because it's a real-time environment. That's difficult. And then managing compliance and transaction monitoring and fin crime and all these things on scale, on massive scale, that's also quite difficult. And being a regulated business does require respect for the regulator, working with them, working in a consciously positive manner, because regulation is there for purpose, to protect, primarily to protect consumers, and working with that, and then figuring out what parts are local, what parts are global, is quite difficult. So the tech piece on the very front of it is quite easy. Running a full stack platform and full of vertically integrated all the way into the central bank or all the way into the scheme is challenging. And that's why, I mean, most of our team are all ex-capital markets, either from a trading side, operations side, etc. We've all got grey hair, because it takes quite a lot of experience and just building the tech. It's about operating it and operating it in a regulated environment on a global basis.
Now, you've explained that banks, regulated banks, are not a target market for you, but you've just described a lot of things which banks and indeed market infrastructures themselves do. Are banks not your market because you don't need banks? In other words, are you making banks irrelevant? The normal term to use here would be, are you disintermediating banks? Are you creating a whole new way of doing what banks do, and so banks become irrelevant? Or do banks continue to have a role in the world which you are busy creating?
Yeah, banks will always continue to have a role, because they are places of safety, and they're generally run by pretty competent people with a good sense of doing the right thing, contrary to what people say in the media and stuff. And they're also essential for capitalism to work, because they increase the money supply and take sort of liabilities and turn those into assets, which are loans, and they can leverage those up to ensure people can buy stuff and stuff. That's how sort of a capitalist type economy works. So they are essential. Very much like in the music industry, the record labels were essential, and they will continue to be essential because they're like custodians of catalogs now. Where we see the industry going, though, is the banks playing more role of APIs around balance sheet, and so being concentration of assets and liabilities there, and being able to use distribution platforms like ourselves, who can originate assets and originate liabilities at a hundredth or more of the cost that a bank can actually do, because that's one of the fundamental reasons a lot of the retail banking ex-lending doesn't, sort of 8 million unserved in the UK alone, for example. The economics don't work. It's $350 CAC cost to originate a consumer. That's $250 lifetime value over 3 years, and $15 to operate a current account over that time. It means you're losing over 3 years or so about $1,800 or so. So the economics don't work, and we radically change the economics, because we can operate an equivalent of a current account about 10 cents a month. We can originate assets and loans at tiny single-digit numbers, which the traditional banking industry does not set up to do either, because of all the primarily legacy costs and everything. Even if you take legacy cost out, your origination costs, if you look at even the neobanks, is still pretty high. It's better, but high. So we think the industry, and it's not just me saying this. This is things like Marty Chavez, the former CFO of Goldman, who's behind, and CIO of Goldman, where Marcus is essentially originated from. It's a bank with APIs around it. I think Barclays are moving into that area. SEB have moved into that area too, because they see this as another way. It's a way of restructuring the industry. What we don't believe in is having millions of balance sheets all over the place and totally decentralized risk, because that is inherent systemic risk in itself. If you look at, say, the US model, you've got 6,000 or so community banks, all pretty much subscale balance sheets. That's a ton of risk within those. I think there needs a bit more concentration of balance sheet, not into one big bank, but that healthy mix where a bank can sustain losses in bad markets and still keep capitalism working. And hence, banks have been around for tons of years, and even modern names like Barclays has been around in the 1850s, has gone through all the ups and downs of the world since then. And my great-great-grandfather was one of the original founding fathers of ANZ Bank, and that's been, he's there in the 1850s or so as the general manager, or CEO as it's called these days. And it's been through famine, war, depression, credit crunch, everything, even things beyond our lifetimes. So banks are there and they provide a good service to society. And I think we just got to reconfigure the industry together to get the economics working again, because they quite frankly don't. And then when you just look at some of the craziness that's happened, I think most banks, it's in the retail world, particularly retail and corporate, non-large corporates, so SME, you've got sort of 95 to 120 odd products, of which only about 5 or 10% are actually differentiated, because a current account is a current account. There's nothing special. You may get a different interest rate in it, but there's nothing differentiated about it fundamentally. And that's one of the, I think, problems that the industry has faced, is very little differentiation in a lot of the products they offer on a scale basis.
So crudely speaking, your vision of the future of banking is one in which you will be a distributor, in effect channeling deposits into the liability side of these banks' balance sheets and channeling loans into the asset side of their balance sheets. So there'll be a small group of banks in each market with a privileged relationship with the central bank, rather like today, but they'll be focusing on their core competence of managing large balance sheets, while actually the product development and the product differentiation, the product innovation will be done by other people like yourselves and your clients, right?
The real product innovation will be done by clients, where it's not so much about the product innovation in a current account, but it's using current account in a financial experience to deliver the value to the consumer. And so you'll see different types of use cases as described, like wage advancing is an easy one to just describe. Will be in Amazon could be doing wage advancing to all their employees, for example. And so that's provides social good for their employees, because it removes stress and allows them to deploy their own balance sheet to help, because they've got plenty on the balance sheet to help their employees. So you see those things where you can get interesting outcomes by just deploying a current account in a way that's totally relevant at that moment in time for financial experience on it. So that's we see this world of where the experience innovation, because I'm not sure there's much product innovation left in the current account, and all the marketeers and the banks are going to shout at me now for saying that. But the experience innovation, I think, is still to come. Very much like nobody thought of Spotify until Spotify just is now prevalent in all pockets, or these are equivalent of.
Yeah, no, I can see it's hard to envisage this future because it isn't that visible yet, and maybe in 10 years' time it'll all seem very obvious to it. Anyway, that disposes of the banks. What about the card issuers? I think I'm right to say you're a card issuer yourself, but you've also said you're on this mission to democratize, reinvent, and unbundle the credit card market. Now, what does that imply for the major card networks, the Visas and MasterCards of the world?
Sure. So the card networks, essentially, our view is they are becoming essentially money moving networks that you have credentials, which is basically your card, your stuff that's in your card chip and your PAN number on the card and your date and the security code on the back. Those are your credentials to move money, and so. The card networks are very much moving to be money moving networks, and I think Visa have made public statements. I just bought my last company, Currency Cloud, and they bought Earthport, and it's all about moving money. So they will always, I think, be there because they are embedded already into all the merchant side who need money, and to the consumer side who needs to pay things with money. So they are the electronic networks. And the same thing with Tencent, with WeChat Pay, with Alibaba, with Alipay, and various other networks. So in Southeast Asia, we've got Philippines, got GCash, and a ton of other type of wallet infrastructures. They're all about moving money. So I think they'll stay, and they'll be just the same as UK faster payments and Visa, so different ways of moving money. So. The unbundling of the credit card market, though, where we've looked at that is not so much about disintermediating any of the schemes, because we are principal members of Visa and MasterCard. The US credit card market is that $4 trillion market held between Bank of America, Merrill Lynch, Wells Fargo, Capital One, and and JP Morgan Chase. And so that is a very controlled, concentrated risk on that. And being able to launch new credit cards is actually quite difficult and timely to do that. And you've generally got to come along with a large consumer base to get the attention of, say, Capital One to launch a program. I think they can only do about 9 or something a year. Whereas we've come along with a total turnkey end-to-end solution that you put your logo on it and off you can go. We can bring the capital in to incubate you, and then once you've seen the dynamics of your credit portfolio working, you then grow up into attaching your own credit line into that portfolio. So it's been able to get to doing 6 to 8 weeks, get a card into market compared to 18 to 24 months. And I think our first ones, which literally did go live last week, so it's a very timely question. The investors in that company is a company called Paceline, so it's the fastest ever credit card program they've ever seen in the world, and they're quite informed investors in them.
You're taking on some big names there. It's another failure by the banks to make the process fast and efficient. I mean, how confident are you can succeed in that market against those major institutions?
It's not so much against those major institutions. We're actually increasing the market rather than taking away from them, if you see what I mean, because we're enabling others to get into the credit card market. So that's a new segments that are being brought in, and there will be some crossover too. But the Capital One was a small business once as well. I know Nigel Morris there, and a lot of his regional team. And my buddies, I remember TransferWise meeting me when they were a PowerPoint deck back 2011, and having to talk through how FX flows are never balanced and everything. So then they helped Crystal and Target launch by being the platform that part of the business launched on, and they've done a phenomenal job at focusing on one area, which is they're focused on the customer rather than the product and the customer outcomes. And you see the DNA in TransferWise and their product people. Their chief business officer, so the person behind TransferWise business is now our head of our chief product officer. If you focus on customer outcomes, there's an amazing thing. Customers come and join you. If you product shift or product push or shove product down people's throats, they'll move away. And the banking world is still in product pushing as opposed to customer outcome generation and customer experience and financial experience generation. I think TransferWise proved that massively, and that's what where the sort of our DNA all comes from. So yes, it's good to compete. and I'm sure there will be some sort of reaction to us as well. But we're here to build a good business. We've got very good backers. Of our backers are all ex-Goldman as well. So we've got some people who know this industry. And even Betsy Cohen, who founded Bankcore. Betsy Cohen, they invested in our last round too, her business, Cohen and Cohen.
Right. Now, you brought up TransferWise. You've made very clear to me that you're not a payments company. You've explained that you admire Stripe. Now, forgive me, I'm a bit cynical about all this so-called innovation that's happened in payments and FX. It's attracted a lot of interest. I was looking at a directory the other day, and I could find 20,000 companies around the planet doing something in the payments area. And you've seen some of these very big names like Stripe, like Square, and so on. What they appear to have done, to my way of thinking, is simply cream off revenues from rather slow and inefficient banks. They've created a great deal of value for themselves and their shareholders, but they don't seem to have changed anything very fundamental in banks. They still rely on bank accounts. They still rely on the basic underlying payments market infrastructure. Now, you're trying to do something very different. You're trying to disrupt banking, if you like, rather than payments. And A, am I right to be cynical about it? And B, what do you think a genuinely disrupted payments market would actually look like?
So it's a very good question. They have built great businesses on focusing on consumer outcomes, and that's what I'm not so sure that banks are sleepy. They just never focused on consumer outcomes. Mm-hmm. And it's amazing what happens when you have consumer-centric companies and non-consumer-centric companies. And there's a great paper actually Frank Rothman from the former CFO of Capital One wrote called The Copernicus Moment of Banking. Yep. Remember, Nicholas Copernicus was the chap who said, by the way, guys, the universe doesn't go around the Earth. And he was sort of badged a heretic. But same sort of thing is that paper is very clear. Banks think about themselves rather than think about the consumer. They don't make it consumer-centric, they make it very bank-centric. And that's reflected in return on equity prices and all sorts of things. So the payments, the other point you mentioned about disruption, disrupting a financial services industry, I don't think is a good thing. 2007, 2008 was sort of testament to over-disruption in there. So I think we've got to look at a migrating an industry to a better economic setup and a better economic infrastructure and a better ecosystem than disrupting it. And I think that is the play we're making and investing in. It's a long-term thematic view of the world that if we can migrate the say consumer, whether consumers or SMEs and retail individuals, to a better place for the economics work. We also get some other nice outcomes. We get financial inclusion can actually start working properly in markets because the economics have changed. Finance becomes inclusive rather than exclusive, and so that becomes a better thing for the world in general, as well as also not disrupting and causing credit crunch again. So yeah, TransferWise said and so there's a ton of people in the FX and that payments world. There was HIFX, there's Currencies Direct, there was Cambridge Mercantile, there was just tons of them. But and they all sold the same thing: better rates than a bank, dedicated dealer, and things like that. And you got lots of smile and dull sales guys on it. And I used to be in that business some time ago. And TransferWise just were the first guys who made it truly digital experience, focused on consumer outcomes, and they just made it better, considerably better. Didn't change infrastructure. Although saying that, TransferWise were the first non-bank financial institution to clear sterling. So they did innovate, and the infrastructure behind the scenes, we were the third. But they trailblazed all the legal setup and everything like that, and we sat on their coattails. So that's the other part. So we aren't really disrupting the industry, we're removing the legacy. And the legacy is what's causing the cost, causing the sort of the slow moving of things, because a lot of the core banking systems have stuff like compliance and all that sort of sellotaped on the side, whereas us, it's baked into the core as well, so we can do things on scale. And the same AWS did it with data centers. Nobody has data centers anymore. They all sit on AWS because it's economic. The economics have massively changed. And without AWS, people like Amazon, Netflix could have never have launched things because the cost of their infrastructure being fast. So the economics wouldn't have worked for the streaming industry. With AWS, it did, and we think the same for the finance industry.
You've been pretty clear that the real agents of change here are the businesses which are actually consumer focused, which banks never were. Now, clearly your customers are not the consumers. So to go back to the original metaphor, who are you selling your shovels to? Or to
Sure.
borrow your later metaphor, who is AWS selling its products to? You're selling it to everybody, to large corporations, to fintechs,
Yep.
challenger banks, airlines. Can I pin you down a bit more on who your customers are? Really, is what I'm saying.
Two main segments. We split between what we call brands and fintech. I think fintech's the obvious one. Brands are people in retail, so it's supermarkets, it's retail consumer brands, the Nikes of the world. It's fan bases, so sports or various things that have fan base economies around them. So it's people who service sets of consumers, whether SME or retail individual. So if you look at AWS, the same thing, that they sell to companies who have consumers, and that's what we do. It's the same thing. We don't generally sell to banks because we've got two massive markets that we just don't need to sell to them, to be honest. And we want to be very focused on the two markets that we think we've got good traction. We think that's where the $7 trillion of embedded finance revenue actually sit, because it's a consumer who has the pound in the pocket. And so if we can connect and help the consumer have great experiences with the brand or the fintech they're interacting with, we get a cut of that pound in the pocket.
Now, investors are obviously convinced by your narrative of the future here. You just raised another $70 million in a fundraising last month. That followed a $37 million raise in the autumn of last year. What are you going to spend all this money on? Is it mainly on international expansion? I see you've got a presence in Asia already, in Singapore and Sydney. What's more attractive to you? You mentioned North America as well. Which do you see the most exciting opportunities, Asia or North America?
They're both exciting. Sorry to give a slightly glib answer.
Yeah.
Our UK and Europe business is almost reaching profitability, so it's going to be a decent scale business. And the other two large markets we see are ones that we know as well are North America and the credit card area specifically, because there's a ton of people doing debit, and it's an oversupplied market. So we focus on credit in the US, and then Southeast Asia, it's about bringing a homogeneous access to a very disparate set of markets. So it's the same thing of having the same Lego in each market. So that's the play in Southeast Asia. Southeast Asia, we've got offices in Singapore, Jakarta, Manila, Kuala Lumpur, and Melbourne as well. And one of the big banks, one of the largest privately held bank in Indonesia, has just invested in that last round too. And the markets there are slightly different because the central banks haven't opened up access to clear the currency. So we will joint venture with appropriate banks there and do it together. And WeWork did the same thing. WeWork was all direct to property in Western markets, and in all Southeast Asia. You look at the original IPO filing that they pulled, all their stuff in Southeast Asia was joint ventures. So it's slightly different. And why we've chosen those, we've got a lot of experience in Southeast. I was brought up there as a kid, and others on my team have all operated in their senior team. North America, we've all got experience, and UK and Europe, we've got experience. So that's where we're most comfortable. We have not even looked at sub-Saharan Africa because we don't know the market. We haven't looked at the LATAM market. It's a new bank. You saw the IPO announcement. It's a huge market. We just don't know it. Three markets I think is big enough to try and tackle and grow at the moment. So we invested in those three markets in different stages. So if you look at UK and Europe has a different growth curve than our Singapore and sort of APAC business and our North American business. So you can almost see them as seed, Series A, Series C, if you looked at it from the investment side and the growth rates you have there.
Can I tempt you to give us a statistic which might be meaningless given that you're at different stages of development in all these individual markets? But if I said to you, how many markets are you in now? Would you be able to tell me? And how many markets do you expect to be in or have plans to enter? What's the total footprint globally?
I won't give the glib thing and count every single European country as a market. So let's say Europe and the UK. That's two. North America is three. Singapore and Australia is five. Those markets were all live and have customers in those markets. We'll be lighting up next year, be Indonesia, Philippines, possibly Hong Kong, when we see how the political situation is looking out there, and also where the capital's flowing, because a lot of the capital's flowing into Singapore at the moment. So that's our plans. And then it's in Europe. We're strong in all the SEPA zone, and so there's other interesting areas like Poland and sort of more Eastern Europe and also the Nordics to consolidate our UK and Europe business.
Now, you made an acquisition last year as well. In August last year, you bought Wildcard Card Solutions. Now, that company had a very interesting recent past. What was the attraction to you? How much of their client base had survived the failure of the parent company?
Sure. So most of Wildcard's business was all card acquiring. So it's accepting cards and terminals and e-commerce, like Stripe type thing. And a large portion of that was high risk. That was a lot of their portfolios. The issuing side of the business was quite small and primarily run out of the UK. They had some running out of Munich. When we heard there was issues with that, we knew the UK issuing side of the business because it used to be called the Newcastle Building Society, and pretty much everybody in the fintech world, they were the people who got everybody in business. Wildcard bought them. So we I call a colleague of mine on the supervisory board of Wildcard, and a lot of colleagues of mine, because I used to be at a bank in the German in Dresden Kleinwort, so I've got good contacts and all the asset managers over there, etc. And so we made some calls to get on the list to say we're interested in some of the assets, and in particular we gave a list of assets we were interested in. So the Wildcard issuing business here in the UK, we acquired that. They had one big client called Payoneer who had left, and the Scott Gallop, the CEO, is a colleague, used to be a client of mine. So I just checked, are you going to stay or not? And he said, no, we're doing our own thing. So that one big client, it was gone, and the rest are pretty much all stayed, if I'm rightly. So they're migrated over. In Singapore, Visa requested a couple of them migrate off Wildcard to us, people, wire-ups and people. And it's now growing with them, adjusting the Newcastle team from Wildcard to ex-Wildcard. They're all solid quality people, and getting our two different companies together and just saying we are one team now. That was a challenge to make sure that, hey, you're safe, you're good people. Who cares if you worked at Wildcard? There was only a few, what's called bad apples in Wildcard, which ruined the whole thing for everybody. You should still be proud of having worked there. It was a good company. So it's a good outcome. I think that transaction hopefully helped the UK fintech scene to some extent, help the regulator here as well, and help some of the banking providers too. So I think together we worked as an industry to make that happen.
Now, we're always looking for patterns, comparators, if you like, to work out which bucket to put a business in. If I said to you that Unit or Plaid are the sort of companies which you think are doing the same sorts of things as you are, would that be correct or incorrect?
So no, Plaid no. Plaid do essentially what is termed in the industry open banking, but In reality, it allows you to gather data from your bank account and third parties to use that with your permission and do payment initiation. So you can push some money out of your bank account and aggregate it together to different bank accounts and manage in one place. So no, they don't. They're extremely good. They're partner of ours, and that data aggregation piece of existing bank accounts, because they don't issue bank accounts, we issue bank accounts, and stuff. Their stack is superb. So there's no point in us trying to build that. That's where we partnered with them. Unit is a software business, same as Synapse FI, Unit, Galileo, all those guys over there. They've got a similar proposition, but they're not a vertical stack at all. They sit on top of the community banks in the US, same as Marqeta sits on top of 90% of the business on Southern Bank. So Southern Bank goes bust, you've got a major problem with Marqeta's client base, and Southern Bank's not a very large bank. So they're all software businesses, and I think they're struggling to, and are not even members of Visa or MasterCard because they're not able to issue cards. They have to have a third-party bank who is a member to do the issuing for them. And so they sit with lovely APIs, lovely marketing and stuff, but they still sit in the legacy. And if their banking partner behind them, whether it's Evolve, whether it's Sutton, whether it's Metropolitan, or any of these banks that got into this industry, primarily because it was tactical. None of the main banks in the US wanted to go in. They'll still tell you what customers you can and can't take on, because their compliance policy is not yours. So Unit has no control over what clients it can take on, the underlying bank does. We're different because we own the full stack all the way from central bank going through. And in the US, we will be doing the same thing. At the moment, we do sit on top of a similar infrastructure to be open with you. But our plans are we'll go straight from the central banks out, and we also are principal members of Visa and MasterCard in North America too.
So if I was to ask you who you would expect to find in the same category as you, what sort of names are we talking about?
You'll find in the same category, I'm talking pure marketing terms, you'd find the Unit would be in there, Evolve, so Synapse FI, you'd find Solaris Bank would be in there, you'd find Clearbank to some extent, but doesn't really do the card issuing piece. Right. So you find those in the category. And I think the difference is the experience that customers have in the category about how can they go to market with and how can they have control over their customer bases as several suppliers deep having impact to them. So they see that in pricing, they see that in agility, they see that in speed to market, and they see that in product development and things. So what we'll see is that I think the market, which Marqeta, Unit and others, it works beautifully in the US, which is a sponsored bank market, so it's well developed, although you still have a third-party sponsor bank dictating what you can do and how fast you can grow. It hasn't worked well outside of the US. So trying to deploy into UK, Europe, Southeast Asia and others, I think they're going to very much struggle. Where it's easier for someone like us to go in and clear dollars directly as we're already clearers, so we understand that very well. Be principal members of Visa and MasterCard because we already issue those cards anyway. We settle and clear with them every day. So I think it's easier for us to go into that market. So I think they'll struggle to go global. They're good US businesses, but not global.
You mentioned open banking, the open banking initiative in the UK a minute ago. Am I right to think that your own origins lie in the open banking initiative in the UK, and that's now evolving into open finance, the long term probably evolve into open data? But do you think you've moved far beyond open finance and are doing something different, or is that still the opportunity you're basically pursuing?
I think it's the open banking again was data aggregation and payments initiation, and it was meant to be the sort of panacea to have cheap ways of lower merchant fees, etc., because you didn't have to pay scheme fees to Visa or MasterCard. The problem is the adoption rates just haven't been there on the payment side. On the data aggregation, yes, it's a super useful thing for many use cases, many lending on credit and also in the sense, say, landlords, if you're getting paid or not. So there's super useful use cases there. On the payment side, it's never really taken off because of a couple of fundamental things. It only benefits the merchant. So the consumers drive everything because they've got the money in the pocket. Literally, the merchant's got the product, but it's a product can sit on the shelf unless it's bought. So the consumer isn't protected by open banking. The consumer is protected by Visa, MasterCard, by chargebacks and the anti-fraud schemes and everything they have. And so I think the opportunity for open banking, and I think this possibly should have been where the government pushed it in the very early days. They were open-minded and leading the world on the thinking there. The implementation, if they brought an insurance scheme into it, and they brought it not as a compliance and an IT mindset, because it's seen as a compliance and an IT issue to any chief executive in the UK market when it was first brought out. They brought it to the commercial side with a ability to engage with merchants and make more commercial money, and also provide a better experience for consumers and less risk and a ton of other things. That could have had much higher adoption rates in reality. So I think it's missed a little bit of a trick, even though the thinking was correct from the execution side. So I'm sure other countries are all looking at the same thing, and I've seen lots of debates about the countrywide insurance schemes to help protect that. But you can see from Visa and MasterCard why they're both either tried to buy into Plaid or the MasterCard bought the other companies recently, because essentially it is a direct replacement for the debit card, because a debit card works off an account, and if there's money in the account, money can go out. It's not a credit card because credit works with credit line. So that I think they sort of threat if somebody did offer an insurance scheme wrapped around open banking payment initiation, that was a massive threat to their whole debit card businesses. So you can see why they've invested in open banking and why they're so excited about it.
You brought up financial inclusion, looked at the other way, financial exclusion, a number of times in this conversation. How can you help increase financial inclusion?
Sure, it's changing economics. The key thing is cost. We plan to get operating an account down to single digit cents per month. Then you can actually build use cases that you can make profit out of places where incomes are radically lower than say Western world, and so which is banking infrastructure in those places is still too costly to include people. So it's that's where it's changing the economics and being able to at a good price as well power up new fintech and brands to engage with those consumers offering financial services. So we see it's an economics thing and it's an empowerment thing, because you don't now have to invest in your own, say, data center like pre-AWS. You don't need to invest in your own financial services infrastructure. You've got it there. So it's like everything. Economics drives everything, I think, fundamentally. You get the economics to work and you can market well, you're in business.
Okay, so it makes those sort of customers economically viable.
Yeah.
Now, you're a shovel seller. You're the AWS of the banking industry. But is the logic of what you do extendable outside the banking industry? And I'm thinking here of things like energy, water, broadband, utilities. Like somebody wants to buy green energy as opposed to non-green energy, or they want to meter their water, or they want to connect to a private supply to the water network, or they want to do something, nothing to do with money, with broadband. Can the logic of what you're doing be extended beyond the sort of banking components of those industries?
Sure.
To get paid for it or not?
Each of those industries is based on a fungible unit, whether it's a kilowatt unit, whether it's a minute, airtime minute or something. And because we look at the world in fungible units of value, And then if you can create exchangeability in that, and have market makers make it exchangeable to say fiat, you then get quite an interesting setup where your power company can reward you with kilowatt hours, which you can go and spend down the pub. That's an extreme case. You see what I mean?
Yeah.
So yes, I think there's ways of transforming industries because they're all based on fungible units. And as soon as you put a fungible unit into a foreign exchange and a spending network, bingo, you've got a new business model that we created.
Well, talking of fungible units, we do, of course, now have these non-fungible units, these non-fungible tokens. But something you said there about paying for your drinks down the pub with kilowatt hours is not a million miles away from the sort of possibilities which are being talked about in the tokenization markets, for example, where you could reward people with electricity as opposed to rewarding them with money. Now, do you have a strategy for and this is a lot of things rolled into one, but do you have a strategy for digital assets, tokens, and indeed the cryptocurrencies out of which the token world has grown?
Sure. Yes, we're live with that, working on essentially tokenized gold already. And so our strategy is the technology works, the market making works, and everything. It's in a closed garden because it's within our platform. And the only reason you need the sort of digital, sort of the blockchain-based infrastructure, if it's then totally federated outside, you got no control. So our next thinking is how do we take the federated mechanisms, which are essentially blockchain-based, and bring that into the walled garden approach as well. Because some will be walled gardens, some will be federated, and they both work equally well in different use cases. So there is the concept of rewarding people with anything that you want to reward with them if there's a price. And there's also reconciliation, which is where the blockchain is very useful, between that unit of value is known as a unit of value. It's not fake as well, which is essentially what the blockchain is all about. So that is our thinking has been. They've had a strategy along that path since we started the company. We've got some use cases up and running, and we see the future is all sorts of stores of value. Going back to the world of bartering, you've got digital chicken and you've got digital goat. You can exchange them. Fortnite, some of the games the kids play and stuff. That's all got that and Razer, for example, and a lot of their stuff has got that ecosystem built into those pure digital economies. And there's one of the things, if you look at it, this is on a theoretical basis. There's a ton of artwork sitting inside the V&A Museum. My wife used to be head of corporate development there, and they know the provenance of it because they're good at provenance. Why can't people invest in that and own it? And it's a way of raising capital for the V&A and people contributing and having some asset rather than just donating money to it. And then the market can be created in it. So as soon as it goes on show, the price may go up. And so there's sort of interesting things that could be done in the future. We haven't had time, to be honest, because we're flat out executing the business as it is at the moment. But I think as we go over the next three and a half years, we'll see a lot more of that type of way of hooking economies together, and liquidity too, which is the most important thing, and provenance. We see that what exactly as you're describing, some super interesting ways of paying down the pub with your kilowatt hours because you've run out of money in the bank account, so you just tap into your electricity company and can still spend it.
Yeah, and on the pure cryptocurrency, the Bitcoin side of things, is that part of your strategy?
The digital currencies, yes, definitely, it'd be part of our. Being an old trader, I like seeing assets that have some sort of intrinsic value and not traded purely on momentum and traded purely on sentiment with no intrinsic value behind them. So I hats off to everybody who trades Bitcoin. I think it's been a wonderful experiment that's opened the eyes of the world. So it's played a massively important role, including influencing governments. But I had this conversation with this chap, Marty Chavez, who's former CFO and CIO Goldman, whose mentors Eric Schmidt over at Google. And the debating the concept of, if I was a product manager and had to invent the dollar today, what would it look like? It wouldn't be paper for a start. It'd have all these different components about it who would be ultimately traceable throughout the world, be ultimately pure digital asset like an iTunes type of thing. You wouldn't have an album cover anymore. So it's if you think of it that way, which I think the central banks are, and you've still got the central bank behind something, which is good for economies, because the Bitcoin thing, I think, is a great experiment, but trying to politically get it off the ground, which Facebook saw with Libra, is difficult. But I'm a believer. I'm a believer. I sound cynical, but I am a believer. If you said
it sounds like you're excited about central bank digital currencies, but somewhat less excited about cryptocurrencies. Would that be right?
Yeah. Yes, I am. Yeah, but also the sort of the other tokenization of.
Hey, I know you were clear about that. Yes, yeah. I see the excitement there. One last question, Nigel. You've raised quite a lot of money over the years. I think more than the 120 odd million which Crunchbase records. But as you look back to that initial seed round you had back in 2016 when you started this up, how much of the original vision you had then remains intact, and how much have you had to pivot, is the phrase, how much have you had to change in the light of what you've encountered and what you've experienced? Is the original purer vision still intact, or are you doing something somewhat different from what you expected to be doing 5 years ago?
No, the fundamental vision stayed exactly as spoken. The only change is we tweaked it to own the vertical stack, because we did exist originally on a third-party legacy bank, and they caused us all sorts of problems with their compliance team not seeing eye to eye with the type of customers we wanted on board, and also the reliability of some of their the payments mechanisms didn't work correctly and things. So I had a conversation with colleagues at TransferWise, because they went straight to the Bank of England to see what their experience was as they trailblazed getting direct clearing access. So that tweak of owning the stack end to end was the piece which we thought could just be a software layer. So that's why hats off to people who are doing the software layer only ones, but we don't think that model actually works. And you've got to really own the stack end to end and be vertically integrated, like AWS essentially is on there. So, but the APIs haven't changed, or they've got better, hopefully got better. The core value prop hasn't really changed. Understanding of the customer bases, where it was all about linking fintechs and banks, has now become fintechs just working on top of us. It's not about linking to the banks anymore. And the development of this embedded finance, as it's called at the moment in the media, but the financial experiences market is another market that we've seen open up as well in front of us. But the fundamentals have remained 99% change, and by sense they're the same.
Nigel Verdon, thank you very much.
Thank you, Dominic. It's thank you for the invitation to talk today.